Hello and welcome back, I guess, to Principles of Accounting 1. Happy to have all of you with us today in this virtual setting. Uh, we're in the fall 2025 semester. No, wait, no, we're not. That's not true. We're in the spring 2025 semester. We're in the fifth week already, if you can believe that or not. So the time just goes by so fast, doesn't it? Okay, so we're in teams today because of the weather. So we're going to go through uh, this week 5 chapter called Accounting for Merchandise Operations. And if you have any questions along the way, just feel free to unmute your microphone and ask your question. I think that'll probably be the most efficient way to do this. And the session is being recorded and will be posted to Blackboard once we're done. So hopefully that's helpful. So let's go ahead and get started and let's talk about this thing called merchandising operations. Now, when we talk about merchandising, I want you to think about my favorite retail company, Macy's, right? Remember Macy's? I told you the story about the red T-shirt and how much it actually cost. Remember that? I want you to keep that same mind frame. So let's talk about Macy's from that perspective when we talk about merchandising and accounting for merchandising operations. So ultimately, what we're doing here is we're going to talk about the retail companies and we're going to talk about how they purchase their inventory and how we account for it. And we do this in a couple of different ways, depending on the type of company that it is. For example, a retailer like Macy's, they purchase their inventory from their distributors as they normally would. But that's going to be different than the way that a grocery store purchases their inventory. And the reason for that is because a grocery store, they sell perishable products, right? That the groceries expire over time. And so, because of that, they tend to purchase theirs using a different method. And we're going to talk about these different methods to purchases and how they're recorded. So I want you to think about how merchandising works and how the costs associated with them work. And this comes from our income statement. Now, as you know, the income statement has our revenue, our sales, and that's at the very top of the income statement. And then below that, we have our cost of goods sold. And then below that, we have our gross profit. And then below that, we have all of our expenses. And that's the typical format for an income statement. That's going to be different from a service company to a retail company and to a manufacturing company. In a service company, they're just providing a service. There's no goods involved. They're selling their services, their consulting services, their lawn mowing services, their plumbing services, their HVAC services, accounting services, law firm services, etc., right? It's a service-based business. They're providing a service to someone else. On their income statement, they're just going to have their sales, which is their revenue. And then just below that, they'll have their expenses. And at the very bottom of the income statement, you'll have net income. So for a service company, it's sales minus expenses equals net income. Very, very straightforward, very simple. Of course, that's going to be very different for a merchandise company like Macy's or Nordstrom or whoever. As you know, merchandise companies, these are retailers. They earn their revenue by selling products, right? By selling inventory. And this could be things like sports goods, clothing, parts, whatever, right? Any type of physical, tangible product. And the way that a income statement looks in a retail environment is we start with our sales, our retail sales, minus what we call our cost of goods sold. Now, just like we talked about before, the cost of goods sold, as the name implies, is the cost of selling the merchandise, right? So think about the cost of merchandise. What is that?
Is
It's
that
the,
the okay?
go ahead.
I'm sorry, really quick. Is
No,
that
you're good.
the price of the item, or is that like the number of items sold?
Yeah, it's the cost of the item. So think of a great question. So think about the way that a retailer works. We know that they sell inventory, right? So where do they get that inventory from? They purchase it from their distributors, right? So so the cost of goods sold is the cost that Macy's paid to the distributor to acquire that merchandise. Now that is not just the purchase price, by the way. It's the purchase price that Macy's paid to the distributor plus things like insurance plus shipping. We call these together, the purchase price plus insurance plus shipping. We call that the landed cost. It's the total price paid to acquire that merchandise, that product, right? So that together, the purchase price plus insurance plus the shipping, the price together, that's going to be the cost of goods sold for that product. So yeah, it's the cost of actually acquiring the product. So we have sales minus cost of goods sold equals gross profit. Gross profit is that it's what the company earned after cost of goods sold. So sales minus cost of goods sold, we call that gross profit. It's gross because it's before the expenses. So sales minus cost of goods sold equals gross profit minus all of the expenses equals net income, right? So this is the typical format of an income statement for a retailer. Now, it's important to think about the retail environment and how their business cycle works. So think about this for a second. How does Macy's pay the distributor for the inventory? There's really two ways they can do this, right? One way is to pay cash for the purchase of the inventory, and the other way is to purchase it on account or accounts payable, right? So they'll pay the distributor later. So the business cycle starts that way. We use cash. The business uses cash. Macy's uses cash to purchase their inventory from the distributor. Macy's then sells their inventory to their customers. Now they can sell it to their customers in two different ways. They can sell to the customer over the counter and the customer pays cash, or the customer might use their store card, which is an account receivable for the business, right? So we got cash sales and we have accounts receivable sales. So those are the different ways that customers purchase inventory from the retailer. Now, the cash, of course, I'm collecting up front. But when it comes to the account receivable, it might be 30 days later that I'm collecting from that customer. Eventually, it all becomes cash, but it depends on how long it takes to collect the cash. We call that the operating cycle. As it starts with cash, goes to purchases, then we sell the inventory. We sell it to either cash customers or credit customers. So cash for accounts receivable. Then a couple days later, 30 days later, we collect on the account receivable. Collect the cash from the account receivable. Then we use that same cash to again purchase more inventory, to sell more inventory. You see, it's a cycle. Sorry about that. This slide is very blurry. It's kind of driving me nuts looking at it. But this is a inventory system graph. And the way that this works is we take our purchases plus our beginning inventory. That gives us our merchandise available for sale. Real simple, right? Purchases plus beginning inventory equals merchandise available for sale. Merchandise available for sale means this is what I have available for sale at this time, at the beginning of the month. That comes from my beginning balance inventory plus my purchases. That gives me merchandise available for sale. When I sell the inventory, it affects my cost of goods sold. As I sell more inventory, my cost of goods sold rises. As I sell my inventory, my ending inventory balance is going to go down. See, think about the physical flow. That's basically what this simple graphic tells us. Now, with retailers, there's a couple of inventory methods that they use, and these two are probably the most commonly used methods. We have what's called the perpetual inventory system and the periodic inventory system. The perpetual inventory system, as the name implies, it's continuous, perpetual, right? Think of perpetual motion, continuous motion, right? What this system does is it updates the record after each purchase is made. Think of how Macy's works. You go to buy the red shirt, okay, off the rack. You pick up the shirt, you bring it to the counter. What happens at the counter? You all know what happens at the counter, right? You picked up the red shirt, you brought it to the counter. What happens?
Transaction.
Yeah, transaction, but how's that transaction work? Think about the actual process.
You ring it up.
You ring it up. Yeah, but
up.
so what happens? Like, there's that tag, right? And
Right.
there's a scanner.
Yeah.
Yeah, and they scan the tag, right? So
And it purchases the inventory.
yeah, that's exactly right. So we call that the perpetual inventory system. So think about that for just a second of how it works. The customer grabs the item off the shelf. They bring it to the cash register. The item gets scanned. The second that barcode is read by the scanner, it takes it out of their inventory. It's no longer available for sale. It's in the process of being sold, is what that scan means. So automatically, the records is being updated. I have one less now. Automatically, I know this because my computer system is saying, hey, there's one less that just got sold, right? It's automatic. That's what perpetual means. So the majority of businesses use the perpetual inventory system. It's a barcode type system, right? Everything's automatic. It automatically updates the number that I have on hand. It automatically updates the amount that I've sold, etc. And it automatically makes that journal entry for me, or the two journal entries for me, because I'm taking it out of my inventory, and I'm also about to collect cash from my customer. So two things are happening here at the very same time. Now, when the customer pays me, that's when it is completely out of inventory, right? That's when it's the transaction's done. Yeah, that's the perpetual inventory system. The other type of inventory system is called periodic. We update the accounting records for purchases and sales at the end of the accounting period. This is true for businesses that sell larger, unique items. The best example I could give you for the periodic inventory system is a car dealership. Car dealerships, as you know, they sell vehicles. That's what they're designed to do. And when a vehicle is sold, there's no barcode that gets scanned. Okay, there's a physical count, right? A physical count. Each vehicle has what we call a VIN number, vehicle identification number, that's unique to that vehicle. That VIN number is a part of their inventory system. Once that vehicle is sold, they do the physical count and it comes out of inventory. It's a unique, large product. Okay, those are the types of businesses that use the periodic inventory system. We update the records periodically. At the end of the accounting period, we do a physical inventory. All right, cool. I'll talk to you a little bit more about both of these systems. So let's go through a couple of transactions that we would use for the perpetual inventory system, and then I think I'll show you at least one or two with a periodic. So real simple transaction, this first one. Our company is purchasing, our corner store business is purchasing $500 worth of merchandise inventory from our vendor, and we're just going to pay cash right then and there. This is a very typical type of transaction for a business like a corner store, right? The vendor comes in, they do a quick count, they say, oh, I see you're short on X, Y, and Z. The person behind the counter says, yeah, we need to purchase more of that. And they just simply, here's the cash, here's the inventory. Boom, simple. So here we have a transaction November 2nd, company purchased $500 worth of merchandise for cash. We debit merchandise inventory, and we credit cash. Very simple transaction. Now, here's the cool thing. Sometimes when a business has the ability to make a relationship with the vendor, we can create what we call credit terms. And what that does is it allows us to purchase inventory and receive a discount. And that discount, it's an incentive for us to pay them before the 30 days is up. So if your vendor says, hey, I'll give you a discount if you pay me early, we call those credit terms. So this example I just gave you is without a discount, but I'm going to show you one with the discount with the credit terms. So here we have credit terms. Our vendor was nice enough to make a deal with us, the retailer, and said, hey, listen, if you pay me early, I'll be happy to provide you with a discount. We call that credit terms. It's an way to encourage people to pay early. Okay, you might have seen this, I don't know, maybe in some transaction that you've had before, where they're like, hey, you know what? If you pay us in the next 10 days, we'll give you a discount, right, on the total purchase. It's an incentive. It's an incentive. And it's a smart one because it encourages people to pay early. So here we have the credit terms. Now, in the credit terms, they set the credit period, which is the number of days of the invoice. They set the invoice price, you know, what's the total invoice worth or total bill worth. The date of the invoice is going to be on there, you know, when it was issued. And then you'll see what we call the discount period. That's the number of days that they're going to allow you to pay and receive a discount. If you pay beyond those number of days, you have to pay the full amount. So let me show you an example of what these kind of credit terms look like. Here we have an example of some credit terms, and we call this 210 net 30. 210 net 30. Here's what it means. I'll give you, the retailer, let's say I'm the distributor, you're the retailer. I'll give you a 2% discount on your total invoice, your total bill, if you pay within the first 10 days. Otherwise, the entire invoice is due in full within 30 days. See how that works? 2% discount if you pay within the first 10 days. Otherwise, the entire thing is due within 30 days. That's what 210 net 30 means. Now, this is just an example, of course. It could be a larger percentage, smaller percentage, larger number of days, smaller number of days, whatever. But this is how the credit terms always read. It's the percent discount over the number of days that that discount's going to be available for. Otherwise, the entire amount's due within whatever number of days that the credit period is. You see? So that's how purchase discount works. And again, usually this is some type of agreement that's established by the retailer and the vendor or the distributor. Here we have an example of an invoice that the retailer will receive. It's who our vendor is number one. The date of the invoice, really important date. Our information, number three. That's the retailer's information. Number four is the purchase order date. This is when we said, hey, vendor, this is what we need, how much we need, etc. That's the purchase order date that we sent to we sent the purchase order to the vendor. Vendor fulfilled it, and now we're receiving the invoice. Number five is the credit terms. In this case, it's 2% discount if paid within the first 10 days. Otherwise, the entire amount is due within 30 days. That's what the credit terms tells us. Number six, this one's good. Free onboard destination. Free onboard destination. FOB destination. What this is what we call the freight terms. The freight terms tells us who's responsible for the merchandise while it's in transit. Okay. Now, it could either be the seller is responsible for the merchandise while it's in transit or the buyer. It depends on the freight terms. Free onboard destination, from what I remember, implies that the seller is responsible for the merchandise while it's in transit. Otherwise, it'll be free onboard shipping point. Free onboard shipping point means that the buyer is responsible for the merchandise while it's in transit. Okay? That's important for insurance reasons of the merchandise while it's being transported. Number 7 on the invoice is a list out of all of the merchandise being purchased, the quantity, the price, and the total amount. Quantity times price equals total amount. We add it all up to get the subtotal, plus any shipping charges, plus any taxes, gets us our total amount. Now, you might also see with the credit terms, number 9, we have what's called the net amount of discount. So, in other words, a 2% discount if I pay within the first 10 days, otherwise the whole amount's due within 30 days. So the total bill is $500. If I pay that $500 within the first 10 days, I'll receive a 2% discount. 2% on 500 is $10. So that means I would only have to pay $490 if I pay it within the first 10 days of the invoice date. Otherwise, the rest of the amount is due within the whole amount's due within 30. Make sense? Credit terms, good? All right. Great. Okay, so here we have an example with the discount. We purchased $500 worth of merchandise on November 2. Credit terms are 210 net 30. We're going to try to take advantage of the discount. So we debit inventory 500, credit accounts payable 500. Now, I'm going to take advantage. I want that, save that $10, right? Dr. B is all about saving money. So we're going to save some money. So we're going to pay them within that first 10 days. So if I pay them in the first 10 days, I'm going to debit accounts payable for the 500. I'm going to credit cash $490. Why $490? Because $10 is going to be my discount amount. 500 times 2%, that's $10. Okay, so I'm going to debit accounts payable 500, credit cash 490. That leaves me a difference of 10. Remember, your debits need to equal your credits. So I'm going to credit an account called merchandise inventory $10. I'm reducing the value of my inventory by $10 when I do that. Right? Because it's no longer worth 500 because I'm only paying 490. Make sense? Great. Here's what it looks like visually using your T accounts, which we talked about way back in, I think, like week 1 or 2. We affected accounts payable, $500. We received the bill November 2. We paid it November 12. We received a discount on the inventory, 2% off of $500. That's 10. And then we paid the $490 in cash. So that's kind of what these T accounts show us visually. Now, what if the 10 days had passed? That means you can't take advantage of the discount. So here we have the example. Oh, the 10 days went by. Now it's too late to take advantage of the discount. So we just pay them as we normally would. Debit accounts payable, credit cash. The full 500. Because we missed that discount period. Never missed a discount period. Save money. Okay. Oh, man. I got to tell you. This part, as a retailer, I don't like this part. As a retailer, I don't like this part. Because I tell you, sometimes things happen, right? Always look in the back of that receipt for the policies, the return policy. Okay, a couple things I want to talk to you about. One's called purchase allowances, and the other one's called purchase returns. A purchase allowance is when there's a price reduction to the buyer for defective or unacceptable merchandise. Okay, so here's how it works. We get a shipment in from our vendor. Comes into the store. We look at the shipment, and we're going through the box, and we notice some of the stuff is damaged. Okay? Now, there's a couple of options here. I can send it back to the vendor and say, hey, ship me a new batch. This is all busted up. That's one option. Another option is I call the vendor up and say, listen, you sent me some damaged merchandise. They might say, hey, listen, Dr. B, sorry about that. Why don't you take a discount on the merchandise? Pay us less for the broken merchandise. That's one option. We call that a purchase allowance. Okay. We also have what's called a purchase return, where they send me merchandise and I'm like, you know what? We don't need this or whatever. So we send it back. Purchase return, just as the name implies. So we have to account for these kinds of things when they occur. So here we have, pardon me. Here we have a purchase allowance. So we received some merchandise from our vendor to our store. We realize that some of it's broken or defective. So we call up our vendor and say, hey, listen, some of this is broken. They say, okay, no problem. Take $30 off the invoice. Great. So the way we do that is we debit accounts payable $30 to take it off the invoice, and we credit merchandise inventory $30. What that does is it reduces the value of our inventory by $30 because, again, it's defective. So that's what we call a purchase allowance. Then we have the issue of returns. Okay. We purchase the inventory. Inventory comes in, $250 worth. We purchased $250 worth of merchandise. It comes in on June 1, and we have credit terms, 2% discount if paid within the first 10 days. Otherwise, the entire amount's due within 60. On June 3rd, we call up our vendor and we say, hey, listen, we need to return some of this to you, about $50 worth. We're going to do it before we pay the invoice. Okay, no problem. So we take $50 off the invoice and we take $50 out of our inventory and we send it back. So debit accounts payable, credit, merchandise inventory, we send the stuff back. Then we got to pay our invoice still. Now, the cool thing is they're still giving us the discount $210 net 60. And I still want to take advantage of that. But we're not taking it off the original $250. We're taking it off the remaining $200. So we're going to debit accounts payable $200. We're going to credit cash $196. 2% of $200 is $4. So debit accounts payable $200, credit cash $196, and we're going to credit merchandise inventory to reduce value of the inventory by $4. That is a great example of a purchase return. I had mentioned free on board shipping point, free on board destination. This tells us who's responsible for the inventory while it's in transit. Free on board shipping point, the buyer's responsible from the shipping point. That's hence the name. Person buying is responsible for the inventory from the shipping point. What that means is that the buyer is paying for the transportation of the inventory that they purchased. In this case, we debit merchandise inventory to raise the cost of our inventory by the shipping amount, and we credit cash to pay for the shipping. In the case where the seller is responsible for the goods while it's in transit, the seller's paying the cost. And so we just debit delivery expense and credit cash. Let's what we mean by the transportation cost. I had mentioned that the total cost of the inventory is not just the purchase price of the inventory, right? I had said that it's the purchase price of the inventory plus insurance and plus shipping. These costs together equal the total cost of the inventory. So here we have an example. Our company purchased merchandise free on board shipping point, which means we're responsible for paying the shipping charges. And the shipping charges in this case are $75. So we debit merchandise inventory to increase the total cost of our inventory by 75, and then we credit cash 75 to pay for the shipping. Okay, what can I tell you about this? Purchases are recorded as a debit to inventory. When we purchase inventory, we debit our inventory to increase our inventory, right? Remember, inventory, that's an asset account. And in order to increase an asset account, we debit it. Let's see. Purchase discounts, returns, and allowances are credited to decrease the value of our inventory by that amount. If we received a discount, if we had to return, except or there was an allowance, that decreases the value of the inventory. So we have to credit our inventory account to bring down the value of the inventory. Let's see. And of course, transportation costs, we debit them to add them in. We add them into the inventory account. And so what this itemized cost of merchandise purchases report shows us is basically an itemization of those things throughout time. Yeah. It kind of summarizes it for us. Okay, let's look at the perpetual inventory system a little bit closer. And then we'll start talking a little bit more about the difference between this system and the periodic inventory system. So one really important calculation that we make is called gross profit. Super important to know your gross profit. This is the profit we would make before all of your expenses. So in this case, we take sales. Well, really, sales minus discounts, returns, and allowances gets us to net sales. We take net sales minus the cost of goods sold. That's the cost of what we sold. Equals gross profit. It's important to know that because when we analyze the business's performance, gross profit is one of the key things that we look at. We'll talk more about that toward the end. As I had mentioned early on, probably a few weeks ago, I'm sure I mentioned this. When we sell inventory, there's actually two transactions that occur at the very same time. Because we need to recognize the sale of the inventory and we need to reduce our inventory, right? We recognize the sale and we got to reduce our inventory. These two things happen simultaneously, but they're two separate transactions. And I'm going to show you what that looks like right now. So here we have a sale of one product. We sold a product for $1,000. We sold it to a customer on account. Means the customer's going to pay us later. So here's the first journal entry that we make. We debit account receivable to increase our account receivable by 1,000. We credit sales to increase our sales by 1,000. That's the first part of the transaction. The second transaction is we have to recognize the reduction of the inventory. So we debit cost of goods sold, $300. Why 300? Because that's how much we paid for it from our distributor. We sold it for 1,000 to our customer. We bought it from our distributor for 300. That means we should have a gross profit on this sale of $700. So debit cost of goods sold 300, credit merchandise inventory 300. With every single transaction, when we sell inventory, it's going to involve these two parts. We might offer our customers a sales discount. This is a way to incentivize our customers to pay us early. It works the same way with our distributor. Distributor does it to us, we're going to do it to our customer, right? We want our customer to pay us early. So we might offer them a % discount if they pay early, otherwise the entire amount's due. Works the same way that it does with our vendors when the vendor offers this. So let's look at a sale with a cash discount to our customer when we sell to our customer. We sold $1,000 worth of inventory to our customer on November 12th. And we said, hey, customer, if you pay us within the first 10 days, we'll give you a 2% discount. Otherwise, the entire amount is due within 45 days. So that's 210 net 45 are the credit terms. So on November 12th, we recognized the sale, debit account receivable, credit sales, and we also debit cost of goods sold, credit merchandise inventory. That was the sale that we made. If the buyer decides to pay us within the discount period, within the first 10 days, then they're going to receive a 2% discount. The total amount that we sold to them was $1,000. If they pay us within the first 10 days, that means they're going to pay us $980 in cash. Okay, why 980? 1,000 times 2% is 980. So we debit cash, 980. We debit an account called sales discounts. Sales discounts, as the name implies, is a temporary account called sales discounts. Yep. It recognizes that discount amount. And then we credit the account receivable for the full 1,000. That's if they pay us within the discount period. If they don't pay us within the discount period, meaning that 10 days goes by, they haven't paid us, they have to pay us within 45 days of the invoice. So here we are, they pay us 45 days after the invoice, we just debit cash and credit account receivable like we normally would. Now, just like we do with our vendors, our customers can do with us. This part pains me. Okay. I don't like when my customers return stuff. I don't like that. It costs me money. I don't like when my customers say, hey, your stuff's damaged or defective. I don't like when they come back with their receipt and they're like, I don't like this. I want you to pay me back. That hurts the business. Okay. Because we basically have to reverse the sale and also lose potential profit. So sales returns and allowances usually involve a dissatisfied customer for whatever reason and the possibility of lost future sales. We upset the customer, they're not going to come back to us. Okay. Sales returns refer to merchandise that the customer returns after the sale has been made. Yep. So the customer bought the red shirt from us, Macy's. All right. We had scanned it. Remember, we scanned it. We made the sale. We made the two transactions. The customer bought the red shirt from us. Now here we are. The customer's coming back. 10 days later, after the fact, they don't like the red shirt no more. Not as red as when they saw it in the store. Right? They just don't like it. Okay? No problem. So we have to give them their cash back, and then they got to give us the merchandise back, and off they go. Easy. I put the red shirt back on the shelf as long as it's in good condition. Otherwise, I got to take it off, send it back to my distributor, all that jazz, and that's a pain. So that's one option. That's something that happens. Another thing that happens is that the sales allowance is made, where we give the customer a discount instead of them giving us the merchandise back. Okay, this one is becoming more popular these days, especially with companies like Amazon. All right, you might purchase something on Amazon, and you get it, and you're like, oh, it's not as good, or it's not what I expected, or whatever's. And so you're like, I'm going to return this. So you might log into the Amazon and go to the returns, and they might be like, hey, listen, you know what? Just keep it, right? We'll refund you, or we'll give you a discount, or whatever, right? That's becoming more popular. That's a sales allowance when that happens. So I'm going to show you examples of both. So here we are. We made a sale to a customer. They came back, and they want a refund. So simple. This happens. They bought $15 worth of merchandise from us. It cost us $9 to sell it. So it cost us $9. We sold it for $15. Okay. So here we go. Customer comes back. They don't want it no more. It's not defective. It's fine. I can put it back on the shelf. No big deal. In this case, we debit sales, returns, and allowances. What that does is it reduces our sales by $15, and we credit cash, $15. We also have to return it to inventory. So we debit inventory, $9 to increase the inventory by that amount, and we credit cost of goods sold to reduce the cost of goods sold by $9. That helps us to return it back to inventory. There's also, so that's one example of a return. It's the easiest example I can show you. There's more challenging ones, but we'll save that for an advanced accounting class. Here we have another example where the customer calls us up and says, hey, listen, this is broken. And we're like, you know what? Y'all can keep that, and we'll just give you a discount on your bill. Customer agrees, no problem. They bought $40 worth of stuff. Some of it's broken. We decided to offer them a $10 discount off of their bill. So we debit sales, returns, and allowances, and we credit their account receivable by $10. Sometimes it's easier to do that than it is to go through the process of returning it. So, we oftentimes in merchandise businesses like Macy's, we have to make adjusting entries. And we have to go through a similar closing process that most other businesses go through, except there's some other temporary accounts that we need to close out at the end of the accounting cycle. So remember, it might have been last week. I think it was last week or the week before. I just don't remember. Like, it's all blurring together. We talked about this the accounting cycle, right? And we talked about this closeout process that we go through. And merchandise business works the same way, but it includes those other accounts that we talked about, like the discounts and the returns and allowances, etc. So this slide kind of shows us like the flow of merchandise during the accounting period, where the costs are reported at the end of the accounting period. So we see period 1 and period 2. Think of this as year 1 and year 2. You know that we can't go into the next year with balances on our income statement, right? Those got to all be closed out. And we got to make sure that our beginning inventory balance in year 2 matches our ending inventory balance in year 1. And so we go through that close process, and this just kind of shows us what the physical flow of that looks like. Nothing really to worry about here. Just wanted to kind of show you what it looks like from a physical perspective. We do oftentimes have to make adjusting entries in retail for various reasons. Here we have an example where we lost inventory for whatever reason. It was either stolen or it was broken. So, I like the idea of Home Goods, right? Or Macy's. Let's say Macy's. Okay, so we're at Macy's, and we're in the homeware department. Okay, so we're up there on the second floor, Macy's, where we sell like fine china, glassware, kitchen stuff, and then whatever other home furnishings, all that fun stuff, right? So what happens? Customer's kid starts running wild through the aisles of the fine china. Well, we all know what happens there. The customer's kid rams into one of the shelves and knocks over a couple of dishes, right? Whoops, right? We call that shrinkage. Shrinkage is a term that we use in retail to represent loss of inventory, whether that be through damage or theft. Those are the reasons why a retailer would lose inventory. Okay? We have to record the value of that inventory that we lost. So the way we do that is we debit cost of goods sold and we credit inventory. Yeah. This helps us to recognize those types of things from occurring. These are the types of closing entries that we do at the end of each year for the business. For a retailer, we have our sales, we close out the income summary like we would normally do, but we also have our other temporary accounts, which includes sales discounts, sales returns and allowances, and cost of goods sold, in addition to all of our expenses. So we add those in to our expenses and we close those out to income summary, just as we would with any other business. But it's just important to notice these different accounts that we have for a retailer versus like a service business or a manufacturing business. This is just kind of like a transactions that we make when we purchase or sell inventory. I love this slide, nice summary slide. Think of this as like a guide, a cheat sheet, whatever they call them, right? It just helps us to it's a quick reference. Think of this as a quick reference slide. Yeah. Then we also have this slide here, also a nice quick reference slide. Just kind of helps to summarize the types of transactions involved in the process. So this one shows us the purchases and sales, and this one shows us the adjusting entries and closing entries. Again, just a nice reference slide to help us to wrap up those transactions. Okay, so now that we had a chance to talk about the perpetual inventory system and the type of entries that we would normally make, I also need to talk about today the income statement in a little bit more greater detail. And there are really two different ways that we can prepare an income statement. One is called the multiple step income statement or multi step income statement, and the other is a single step income statement. Now, as the name implies, a multi step income statement has multiple steps to preparing it. The first step is sales. So we got our sales minus our discounts, minus our sales returns and allowances equals our net sales, minus our cost of goods sold equals gross profit. That whole part, that's just one step. Okay. The next step is we have all of our operating expenses listed out. So we see our selling and then our general administrative expenses all listed out to give us our total operating expenses. So we take our gross profit minus our total operating expenses equals our income from operations. So that's the second step, right? All the operating expenses. Then the third and last step is I have my income from after my income from operations, I have my non-operating activities. These are things like interest, taxes, gains from sale of assets, etc. All those kind of random accounts. So we take our income from operations minus our total other revenues and gains or losses equals net income. Again, we call it a multi-step income statement because there's multiple steps to creating this income statement, which is a lot different than our single step income statement, where we just have our revenues equals total. We add up all our revenues to get the total revenue, and we list out all of our expenses, which includes cost of goods sold, to get total expenses. Total revenue minus total expenses equals net income. That's one step. Very simple. But you'll notice that the biggest difference between the two is that on the multi-step, we separate cost of goods sold. We do that on purpose because we want to be able to attribute the cost of our inventory to be easily identifiable. Right? That's why we have cost of goods sold listed out separately in the multi-step income statement. Whereas in the single step income statement, we just have it lumped with all of our other expenses. So from my opinion, the best of these two is the multi-step because it gives us a lot more greater detail. And as a manager, it helps me to more effectively manage the business. So that's the difference between the single step and multi-step income statements. Then I also need to quickly talk to you about the balance sheet. We have, as you know, the balance sheet lists out all of our assets, liabilities, and equity. We also have what's called a classified balance sheet. A classified balance sheet, as the name implies, classifies our assets according to their liquidity based off of whether they're current or non-current. In accounting, when you hear the word current, it means 12 months or less. 12 months or less is current. Think current year. 12 months or less. If it's long-term or non-current, that means greater than 1 year. Now take a look at this classified balance sheet. under our current assets, we have cash, accounts receivable, inventory, office supplies, store supplies, prepaid insurance. Those are all what we call current assets. We expect to utilize these assets in 12 months or less. That's why we call them current. So we add up all of our current assets to get total current assets. We do a very similar process with liabilities. With liabilities, we separate those out to either current or long term. Current liabilities are liabilities I need to pay within 1 year or less. That would include things like accounts payable, wages payable, taxes payable, right? Those are all current, 12 months or less. Then I have long-term liabilities. These will be things greater than 1 year. That would be like notes payable, mortgage payable, car loan payable. Right? So on the asset side, we have our current assets. We also have non-current assets. Non-current assets, that's property, plant, and equipment. Property, plant, and equipment are non-current assets. We expect to use them for more than 1 year. Property, plant, and equipment. On the liability side, we got current liabilities and long-term liabilities. By classifying them, we're classifying them as either being current or non-current, or current or long-term. Right? That's a way to think about it. When you hear classified, we're classifying the accounts based off of their current or non-current status. So that's the balance sheet. And then, we got a couple ratios. So, you love the ratios. Come on. You love them. Okay, here's a ratio. This one's good because it measures the merchandiser, the merchandise companies, Macy's, ability to pay its current liabilities, also known as liquidity. We call this the acid test ratio. It's different than the current ratio because we exclude less liquid current assets like inventory and prepaid expenses. It takes a longer time to liquidate our assets like inventory. It's hard to just sell the inventory, right? It takes a longer period of time. So in order for us to really assess our current assets that we can sell quickly, we call it the acid test. So we take, they're also known as quick assets. We can quickly convert them into cash. So we take cash plus short-term investments plus accounts receivable. Those are our quick assets. We divide that by total current liabilities. That gives us our acid test ratio. A 1 or better is good. 1 or better is good. Less than 1, they in trouble. And this is an example of the acid test ratio performed on Nike and Under Armour. We can see that the current year for Nike is pretty good. It's above 1. Current year for Under Armour is pretty good. But we notice Under Armour's performance a year ago and 2 years ago was below 1 at that time. So they were having a risk of liquidity during those last 2 years. So that's why it's a good ratio to kind of calculate once in a while, just to kind of check the financial health of the company and their ability to repay current debt. And another ratio I like a lot is the gross margin ratio. Love this ratio. Without enough gross profit, a retail company can fail. Right? They need to have some gross profit. The gross margin ratio helps us to understand this connection between profitability and sales. And so to calculate this, we take our total sales minus cost of goods sold divided by total sales. Now, what that does is it gives us our gross profit margin ratio. The higher, the better, of course, right? For me, what I would consider to be good gross margin is 30% or more. That's what I would consider good. But that's just me, right? And then these next few slides, this is just summaries. And these summary slides, they show us the difference between the periodic and perpetual inventory system. As I had mentioned earlier, the perpetual inventory system, it continuously updates. The periodic one, we have to do physical counts. And it's really only used for larger products like a vehicle being sold at a dealership. So you'll notice that between the two, there's not a whole lot of differences other than the way that the inventory is tracked. And that's really, I think, is the biggest difference. That's really what it shows. This shows us just the differences between those two. What else can I show you? Oh, so sometimes as we're planning for the future of the business, we like to plan our sales with any discounts already in mind. So if we have an expectation that we are going to receive a discount or give a discount, it's important for us to estimate that discount. So in order for us to make an estimation, we do this thing called an adjusting journal entry. And in this case, it might look something like this. So here we have a situation where we have an unadjusted accounts receivable of $11,250. Our sales discounts were 0. 2,500 of it are within a 2% discount period. We expect the buyers to take $50 in future discount periods, which is the 2% of 2,500. So if we expect it to happen, we can make an adjusting journal entry at the end of the year. Like if we're expecting this to happen in the following year, we debit sales discounts and credit allowance for doubtful accounts. Or I'm sorry, allowance for sales discounts. It's kind of like an estimate. We could always make adjusting entries for estimates. What else can I tell you about this? Yeah, I think that's all I wanted to say about that one. At the end of the year, we need to make adjusting entries for other things like refunds. So when there's a refund involved, and we're at the end of the year, we expect to give a refund in the following year. According to the matching principle, we need to make the adjusting entry for that year that we made the sale in. So in this case, we would make an adjusting entry at the end of the year, debit sales returns and allowances, and credit sales refund payable. Also, at the end of the year, sometimes there might be an expectation of a return of inventory in the near future. And so in that case, we debit an account called inventory returns estimated, and we credit cost of goods sold. And then this is, again, just kind of to show us the comparison between the perpetual inventory system and the periodic. And that is the end of our discussion on merchandise, retail, inventory, whatever, all that fun stuff. Any comments, questions, concerns about any of that stuff? or does it all pretty much make sense? Is it logical? And what are your thoughts?
I think I get it.
Okay, good. Good.
Yeah, it makes sense.
Awesome. Perfect. Great. Okay, just to kind of recap, I'm sorry, I just closed my share screen. I just want to just one last time, I promise. Just want to show you again the classroom for this week. For Sunday night, we have the quiz related to this chapter. So just go ahead and open up week 5, and then your chapter 5 quiz is going to be there. I'm going to post the recording of this session to the classroom as soon as it becomes available. And if you have any other questions along the way, just feel free to, just shoot me an email or whatever. I'll be happy to help you out. We good?
Thank you.
Yes, thank you, Professor.
Okay,
Yeah,
thank
thank
you so
you.
much.
Good.
Appreciate
Thank
all
you.
of you.
Thank you.
Have a great rest of your
All right.
night. Stay safe out there, okay?
You as
Catch
well.
you.
Thank you.
All right, thanks. Appreciate you. Have a good one. Bye-bye.